So I'm going to start by today's discussion asking you, which camp are you really in? Now, are you in the camp that, you think that the tightening or whatever policies are being taken by the US Fed are going to put an end to the ongoing bull market? Now, when you're in that camp, the question is, if you're just gotten into that camp now, then it's a fair discussion. But did you think the same way when the QE started, when quantitative easing actually started, not just in 2011, but when it resumed in 2020, when it was tapered in 2015-16, and then they started to raise rates into 17 and 18? Did you think at each time, whatever policy moves they were taking, that they're going to bring down the system? So if you're really following that narrative, which has become quite popular in a lot of YouTube videos, and I know a lot of people message me on Twitter about different handles that are either giving, very big predictions on market moves up, then it'll crash, then this will happen, then that will happen. I'm not sure how that helps mentally, because psychologically, if I tell you that the market's going to go up and then it's going to crash by 50% and then rise again, you'll probably not invest out of the fear of the crash. So, unfortunately, that kind of thinking doesn't help. Unless that is the view you want to push, I'm not sure why somebody would really, give it out that way. And then there are, of course, many others who, like I said, irrespective of what the Fed does, what the central banks do, end up having a bearish or negative view on equity markets. And so that's another completely different camp. And after some time, you'll wonder what their reason is, because no matter what happens, they'll either be pushing you gold, and probably that's their main business, or they've probably ended up in the wrong camp, So there are services that I've tried and seen that talk that way, and then when you look at them, and if they're wrong, they'll probably be pushing you some equity asset class or the other. And so there was an interesting interview even this morning I saw on Double Line Capital's YouTube channel, where they were interviewing a couple of people, one of them being an economist who's typically bearish on the US and has been at least for the last several years. But the question was not opinion based, but really positioning based. What would be your best bet? And he actually ended up saying India. So that's what I also mentioned, I think, in one of my previous videos, that where I was trying to explain how you should, really approach the markets and this thinking. People who have been, pushing different kinds of ideas have their own long and short positions, and understanding their positioning can sometimes throw better light on what they really think about the markets versus what they seem to be saying in their talk. Because if you listen to their talk, you'll probably never invest. And so I actually got two people, saying that India was on top of their list. And I know at least another research house that tracks India closely in terms of their emerging market exposure. So the funny thing is, despite all this happening, when is the trigger point going to be in terms of the FII flows really coming into India? What we've really not seen so far, and so with that, I'll actually try to move to my screens, is that we haven't really seen huge FII flows. Not even though we've started the current year. Okay, if we actually look at daily buying and selling stats. Okay, so I'm looking at the daily stats for this month. This is of course FI and DI together. Let's just look at FI. They actually turned mildly positive compared to the last month. Last month was all red. We all know that. Except in the last week of the month, maybe it turned mildly green, but that's also the holiday period, so you may or may not give it full weight. But the moment we started the current month, that is January, we saw a bit of green. It looked a little optimistic, but then there was this big red and then a little bit, let's see. But again, I'm not so kicked off by looking at these numbers. 100 crores, 400 crores, I've been used to. 100 crores a month used to be FII flow in 1994. The first time I saw a 2000 crore positive number was halfway into the tech bubble. May of 2000 is when I remember seeing it. It was the biggest number at that point of time, which is why I remember it. And then by 2008, we did get periods where you can get 1500 crores a day inflows, or during the bear market, even 2000 crores of outflows. But now we are not really seeing those kind of inflows. I think since the pandemic lows, India somehow has not seen FII flows turn aggressive, even though the indices have more than doubled, which is quite surprising. Never really seen that kind of behavior from FIs before. And I would have understood that in the preceding period, 2013 to 2020, when also they were a little more active and more positive than they have been this time round. So that's a big surprise to me. But is that about to change? So that's, I think, the big discussion I want to have today. So as we get down to it, I'm actually opening up a chart of the currency pair. So let me just try and move this a little bit here. Yeah. To the left hand side, so you can actually see all the pairs on my screen. And the reason I've loaded this up is that there was a news item this morning. I was listening to someone saying, oh well, US markets sort of recovered and went positive, even though Powell had some things to say. So what I understood from what Powell had to say on Bloomberg is that even though he didn't really back off, I mean, some may say that he still sounded hawkish or whatever, but he didn't really back off from his policy perspective. Of course, he's not going to. It's too soon for him to do that. It's not like markets have tanked and he has to reverse policy. But if you're looking for anything, the only clue the news channel was trying to throw up was that he said he'll let the bonds roll over. So the way they're going to really reduce the balance sheet is allow it to roll over rather than actually reduce it by selling bonds in the market. So if it's a planned reduction, something they were trying to do, I think in 2017-18 or somewhere, if I'm not wrong, or maybe I am, I don't remember, but I do think they were trying to taper back then, or move from tapering to an actual balance sheet reduction by the planned exercise. So if you start doing that, then it has a more negative impact. Allowing the balance sheet to run off simply means that they will not repurchase bonds that are expiring. Okay, so of course there are always treasuries that expire because they are all dated, right? Even in India, if you think of the 10-year GSEC, it's not always 10-year. It becomes 8, 9, 7, 6, 5, 4, 3, 2, 1, 0, and then it expires, right? There's a date on that 10-year, and once it's gone, then there's another 10-year issuance. And so there are issuances by the government from time to time, and as and when those issuances expire, they have to be rolled over, and the RBI or banks that are investing through SLR would all finance those treasuries in India. In the US, the same way, the US Treasury and the Fed steps in when it's really needed if there's not enough financing from banks. And so that's what QE is all about, buying the bonds, buying bonds so that interest rates do not rise in the market too much and you support the bond market. So the other way would be that one is, of course, they stop buying bonds. That is, that's your tapering step number one. And the second is actually starting to allow the balance sheet to run off, which is, okay, if the bonds expired, we are not going to buy the forward lot. And so that way it will slowly reduce the balance sheet size on its own in a normal routine manner rather than, any actual bond selling onto the market. Okay, fine. Let's see how that goes. And we'll actually see month on month then how much it reduced by. And so that leaves the boat open, because I think what the Fed also said is that they will change policy whenever it's needed. That part people forget. He said that a couple of months back, and when he got into this mode that he needs to taper and address inflation, he'll be very happy to change his stance as and when needed. So now that takes us back to what the dollar's been doing. I mean, we all look at the dollar index. Okay, so if I want to start with that, I can start with that too. I really like to recently start looking at the euro. Now the reason I look at the euro, so I'm going to blow up this chart, which is the euro. Then I'm going to switch back to the dollar and then the euro. So here you have the dollar index. It looks like an HNS or looks like a triangle. Now if it's a bullish triangle, it takes support on this line at 95.51 and then starts heading higher. But my view is that most probably it is petering out. And the biggest component of that is the euro. So which is why I started with the chart of the euro to get a confirmation that the dollar is really breaking down. Apart from closing below this lower line at 95.5, what I would really want is the euro to break out of a similar level. So let's go back to the euro chart, because it's the, like I said, biggest component. Has a nicer triangle, and I've shown here 9%, 11%. This is the daily sentiment data, which I also publish now on Indiacharts from time to time. The entire table, which includes all the currency pairs and commodities and so on. So if you are interested in the daily sentiment index, you can find it there. And so it was 9% for the euro back here in November, and then 9%, and at the lowest point 11%. And so these was, when you get these single digit or near single digit readings, they're usually the extremists. The last time you would have seen an 8% reading was down here at the bottom right after the pandemic when the euro bottomed. Okay, and actually it would have been here, not at the bottom. So sometimes sentiment can be a little higher at the lowest point because of a positive divergence, and this rally would have led to the sentiment turning positive and then selling off, and then whatever happened. So 9% reading is now the first time since the 2020 low we got a very extreme reading, which is why I would think this is the bottom. And I would like to mark the bottom end of this channel as WXY and complete, even though you can argue, this is A, B, C, and this is 1, 2, 3, 4, 5. So that's a count that EWI is leaving open on the table, that this triangle has a bearish fourth wave triangle and you get one more leg down. But I think it's also possible this is ABC x ABC. It's done at the bottom end of the channel. We've reached an extreme in sentiment. It's a 66% retracement of the last rise, and the euro should be ready to rise all over again. So in other words, what I'm saying is that the 1 year decline in the euro or the rally in the dollar is should be coming to an end, and the confirmation is going to be a breakout or close above 1.139 in case of the euro and 95.5 in case of the dollar. Now this fight, while this might not have happened, the reason I was amused by the news trend saying the dollar was up or something like that, and it was actually down yesterday, so it was up day before. And I think the news item was talking about maybe the dollar against emerging market currencies. And so I actually ended up opening this chart where I have all the 6 EM and developed, not developed, rather commodity currencies on a table to see how they are doing on a day-to-day basis, which includes the Brazilian real, which has been one of the weaker currencies throughout this pullback. And of course, Brazil has also gone through a deep correction in terms of equity. But longer term, over 2 years, it's formed a big triangle. So it was making this last attempt to come back to the top end of the triangle. But what's happened over the last few days, it's actually been strengthening. So we are seeing a strengthening trend, which is the USD going down. USD BRL going down here actually shows that the dollar fell last night against the Brazilian real. The same was true against the Australian dollar, which is your commodity currency, Canadian dollar, which is also a commodity currency. So when we look at the dollar index and we hope that when it declines, commodity prices go up, the commodity currencies, which is Australia, Canada, and all also tend to go up against the dollar, which means the USD AUD goes down or the USD CAD goes down, which is what we are seeing over here. So all of these going down are reflecting a declining dollar because they are all USD pairs. I have not taken the AUD USD, but USD AUD. So everywhere I've taken USD pairs so that if they are all falling, I can judge that the dollar is falling. And that's sort of what we saw, except for the Japanese yen, which tends to always do something different. All of them were actually down, which means the dollar was down against even the African rand and the British pound. So the only one which has not been leading this phase being the euro, right? Euro is forming a triangle, but if I look at the British pound, it's pretty much strengthened as the USD GBP has fallen over the last 10-12 days. And this is the same thing you can see against the rupee also, right? The rupee, or USD INR as we call it, strengthened over this time period. Huge line of strengthening. Bounced a little bit and has broken this low, I think, in the last 2 days and gone even lower. So clearly this is wave 1, wave 2, wave 3 down has already started in the USD INR. Very strong signal for equity markets, that is for the Nifty in India, because whenever the USD INR goes down, the rupee gets strong, equity markets in India get strong. But despite that, despite all of this, the surprise element is FII flows still not really showing up on the shores. So I'm going to go back to that earlier chart and I'm going to open the MSCI Emerging Market Currency Index. Surprising, I didn't write about that on Indiacharts for quite a while. And so I was just talking to one of the media friends this morning and I mentioned it and then I said, oh shit, haven't I really looked at this recently? So the MSCI, okay, this is what I like to look at, the currency market index. I think this one is the one I've discussed many times before. So let me see if it has my earlier markings. Probably not. Looks like really a long sideways pause, more than even, there's no decline here. So the emerging market currency index as a basket is really not shown much of a decline. So I would have thought this is maybe one big wave up, down. This is a good ABC correction. Okay. And so if I actually use the A, B, C, if you actually understood what I'm trying to say. So, and then you started a new bullish trend, and then sort of you got a pause. Now, I don't know whether this pause visually looking like a triangle, but it could be WXY, or this could be the fifth wave, and then a pullback. Actually had counts on one of these indices. So I'm going to try again. The second one, because one of these I've actually marked my counts, and that's the one I usually publish. Now, if I look at this, it will appear a little more clear. Again, I'm doing this roughly. Usually I do the detailed internal structure before I even think that something is a wave count. What I can see here is a very clear 5-wave up, ABC down. And I would sense at some point of time, sooner than later, we are going to start another 5-wave up. Right, so moment you get strength in the emerging market currency pack very, very clearly, it will be a good sign for the emerging market stocks as well. We are seeing some of that recovery in Asia, but you want to see it around the world. So, very early move here, not looking the same as all the individual currency pairs. So I really don't know whether the EM index really covers AUD, CAD. I haven't checked the components, but when I look at those components which I've put together, they was strengthened against the dollar, and if that was true, this should have gone up a lot more than it has. So probably there's a different basket. This may include even others like Turkey and so on, may have its own reasons for not having moved a large amount. And the other thing you want to then check simultaneously is the emerging markets index, right? The stock index. So this is the MSCI Emerging Markets ETF, the EEM code, which is actually equity. So here you're seeing a downward channel for almost a year. So this index has very much correlated with the dollar. When the dollar is rising throughout 2021, the EEM index has been sort of down and under pressure, which reflects what's happened in most of Asia, Brazil, Australia to some degree. India's been the unique place which tends to correlate more with the US for whatever reason always, and has outperformed. Or you can say that India has actually done something unique of its own and managed the current global pandemic much better, and with the stimulus measures, the budget that we had last year, which was also expenditure driven, which is why we have good growth this year, and I would hope for the same next year as well. So this index is broken past, so I would actually start marking this as an initial 1 and 2. Maybe it's an expanded flat. I'm not going into the hourly charts, and it's kicking off a third. So it looks like the MSCI Emerging Market Index has already started a rally, and this sort of fits in with what I just showed you on the dollar chart, which is that a lot of the dollar pairs started to show the emerging market currency pairs strengthening, even though the EM currency index is not showing it that clearly. Last and not the least, when you get a commodity, when you get a dollar bear market, what you would look for is commodity prices. So look at the Bloomberg Commodity Index. Okay, that's done much better. Okay, you can again here you can see an ABC correction, which is sort of this part of it. And then we've started to try and recover from there. This has gone back to the previous lows, which is why I still think it's a fourth wave, meaning that this was wave 1 and 2, and this whole thing is a third wave. And this fourth wave, usually fourth waves of a higher degree go back, don't break the previous fourth wave support, and that it didn't do. It didn't even touch it. It could have gone a little deeper, but it didn't. And I think oil really helped in this regard, because I think oil is the main one that led the entire advance that we've seen recently, because this trend line of the last two lows is where we hit support. Okay, and this then ends up looking like a very broad triangular structure. So it could very well be a fourth wave, because the second wave here was a zigzag, which is this. So what we mean by a zigzag is essentially an ABC correction like what you're seeing over here. Okay, and then when we're looking at this entire structure, you can actually think of it as a triangular expanding structure, more like a fourth wave. So I would like to think whether this is broadly some kind of a 3 and a 4. Now note, these are not the exacting counts. When I actually marked this entire rise, I initially thought maybe the fifth is ending here, because internals, if I do internals wave counts, it actually looks like the 3 is here, and this is not an expanding triangle, but it's actually then a flat or a complex correction. So it can be very different in terms of pattern, but the visual of this kind of a pattern is typical of a fourth. Now later on, if it does change and you have more extensions in oil in a long-term trajectory, we'll have to actually think of this being 1, 2 and then this again being 1 and 2, which is where the flat structure will fit better. Now some of you will say, if this is 1 and 2, then how far is oil going to really go? And the reason to think about these things is that this third wave can actually appear shorter than this first wave. And the reason for that shortening exercise is that you had a big sell-off, it may not appear here on this chart, but you had a big sell-off in oil here, this spike down. Now, even if I don't take the entire spike down, the spot dollar went even to $7. Even from $7, if I take this first wave to this high, it will end up being larger than the third wave. So it will sort of make this third wave look small. That's the only reason to think about. If it's short, then is it a third or is it just 1, 2 of the third? And if that is the case, then are we going hyper bullish on oil? Well, at least I know one thing. The case for a bullish oil does exist. I've discussed that in a winter update post as well yesterday. If you haven't really seen it, just go to the website, scroll down, go to the winter update here, and I've written about oil. This chart taken from, I've mentioned the website's FFTT, showing global discoveries of oil deposits per year, which are going to decline. New discoveries at the lowest level in 2 years, and actually in 50 years, they say this reading is like the lowest in a long time. And that sort of will put you in a position this year in 2022 where you will not be able to produce enough when it comes to demand. Very different analysis that sort of supports the idea which I am trying to show on the oil chart, that it can be an extension. But for the time being, I'll take it as a fourth wave because of this triangular look or the expanded flat kind of or running flat kind of look. And so presumption is this is the fifth wave that has started. And if this is the fifth wave, we've probably done 1 and 2 of the fifth, and we're exploding in a third right now. This could end, you could get a fourth wave, then you could get a fifth, and eventually you end up somewhere in the 90s or even $100 if I take the slightly bigger picture, because if we actually get a fifth wave, which is even if it's a little shorter than the third wave, it's going to go much higher. You're going to cross $100. So I think that's sort of set in this trend. And this trend will coincide with the commodity index, right? It's not, oil doesn't ever do anything standalone. Just like I've shown between oil and equity, the only time when equity panics against oil is if you get an oil shock. Oil goes from $60 to $100 in 5 days or 4 days. So that's an oil shock. That will cause equity prices to fall and people to panic on inflation or interest rates or whatever it is. But if it's not an oil shock, something that happened in the 70s in India, and you got inflation, you got prices going up once and for all, but then they came back down, but never back to the levels that they'd gone up. That's what I'm told. And so if it's not an oil shock, if oil prices are rising steadily along with the growth and the economy, then sort of it ends up getting absorbed. We've seen that between 2008 and 2002 and 2008, when oil went from $15 to $130, and so did equity. So the point being, the bullish view on oil shouldn't be taken as a negative. I've already explained that in depth in previous videos. Then the real catch is going to be how commodity price is going to play out, right? So if oil is going up, most commodities are going to align with that as well. And we can see that, and if you're too focused on only maybe copper, which was languishing for a while, still trying to pick up from this long consolidation, but broadly speaking, on a 1 year basis, it's at this highly elevated level, right? It's not falling with the dollar rising last year. So it's sort of just consolidating, and that means that the benefit of higher prices is still going to come into the companies that are producing it. But some of the other metals are actually going crazy. Here's nickel, made a new 52-week high, or is it an all-time high? No, not all-time yet. It just surpassed the 2013 high. The all-time high is somewhere way up here from 2011. So we're not there yet. But we are at a 52-week high. So it surpassed everything. Last night was a good 3-4% move, I think, in nickel. Also similar move was there last night in zinc. And so zinc prices also ended up higher. And not a 52-week high, but yeah, higher from recovering from the sell-off we saw in November. So, and the same in aluminium as well. So we're sort of seeing not just emerging markets and commodities beginning to pick up ahead of the dollar actually breaking down. So by the time you actually get the breakdown, so this is the main point. By the time you actually get this euro breaking out and the dollar confirming, I think everything is already, people have already taken an advanced bet that it's going to happen. And I don't know what narrative you are listening to, because if you are listening to, and that's why I started this today's discussion that way, if you're listening to channels that are saying, no, this is not going to happen, dollar goes up, everybody dies, the market doesn't care, it's doing the opposite anyway. And so if you're trading looking at the dollar, then you're anyway getting it wrong. And so you need to look at what each individual asset is doing and maybe do a reverse judgment. Try to judge what the dollar will do based on what everything else is doing. How about that? And why are you trying to look at the dollar and judge that markets will fall? How about judging that markets are going up, commodities are going up, EM currencies are going up, which means the dollar will fall? How about that for analysis? So, we're rooted to one-way thinking, and sometimes avoid people who are trying to make you think that way. If somebody is telling you, just watch this, it's all going to happen, and then it doesn't, and then again it's going to happen. At least you got to be right at some point of time. So there needs to be a thesis and logic that is playing out. Something has to be playing out, if not everything. See, everything doesn't always play out. I know the dollar was actually in a bull market between 2015 and 17, 18. I thought it would have had a huge negative equity impact. It did have, but only on segments of the market where there was high debt. So that part of it played out. But the defensive plays and the changes in indices at least kept the Indian Nifty higher, but most emerging markets remained in a bearish mode throughout that time period. So the thesis at least was right. And it played out not just there, it also played out in weak commodity prices. So there was a place to actually take that trade. So if you have a negative view, there should be a place to take that trade. Right now, the bullish dollar view doesn't have any place to take that trade. You haven't had a crash in commodities. There have been some corrections in some emerging markets, but it's not. They've not really been windfall shots that you would have done. Some of them would have been good, maybe in a Brazil or some Asian markets, but I don't think Japan really fell off the cliff. So you wouldn't have had it there. So it would have been better to really wait and take and imagine with that view, you actually end up missing out the long trade when it happens, because if the bull market is still on, then which side are you really on? Are you still trying to think that the Japan should actually crash or the US market should fall? I think what the falling dollar can at most do, which it did between 2002 and 2008, is get us to a point where the US equities, even though they're advancing, they may advance a little more slowly and underperform the emerging market complex. I think that is going to be the interesting trade of the year, is the shift in terms of performance from developed markets to emerging markets. I think that's going to be the big one if it really happens. And within that, like I said, I am hearing increasingly people talking about India. I don't know when FII flows come back. They should, if a lot of the global funds are watching India as a destination in that EM switchover play, then this MSCI Emerging Market Index jumping up should be the first signal that India is going to really make it. See, I'm talking about everything and relating it back to India without really having opened an India chart, and except for the rupee. And so I'm coming back to what India has done so far. Okay, so far it's broken out of this declining trend which lasted for around 2 months, which is absolutely normal in terms of time, because sort of it would have taken the same time from here, this top in sometime in mid of Feb, to this bottom sometime in late of April. Okay, is approximately 2 months. Okay, so that's completely normal. And this top around the 28th of October going all the way to, or 20th of October going all the way to, what date was it exactly? Yeah, it's around the 19th, 20th, 19th of October going into late December, 20th of December. That's also around 2 months. The time horizon is absolutely the same. The only difference is in the depth. This was a little less deep. This one has been a little deeper. And just because it's been deeper, people feel that, oh, this was the end of the world correction. And missing out on the idea that the bull market is still on. That's my thought. We are seeing that in the mid-cap index as well. Nice, good downward flag, if you want to call it. Breakout. And the rally is still going on. Okay. Don't go by these markings. These are just my alternate markings. Alternate markings which were, since you've seen them, trying to consider something much bigger. Like even if it's an ending pattern, it will look something like this. Then this would be A, B, C, D, E, which still means you make new highs in the mid-cap structure. And the more bullish wave count would be to actually consider this as 3 and 4, and then the 5th forming. So those are the two ways of looking at it. And we've sort of broken out in almost everything. I think the big surprise for anybody would end up being the Bank Nifty, because while we can argue whether 5 waves are over for Bank Nifty, if it is not, okay, and it would not be in case this entire correction, this entire thing from April to whatever has happened now, okay, ends up being a running flat. Okay, it ends up being a running correction inside this larger parallel channel, and now it is done. And if that is the case, then this entire period was a 4th wave, and we actually started the 5th wave only now. Because this rally from the bottom that we got in April was very lethargic in Bank Nifty. The counts are also not clear, not the nicest, and broadly speaking, it would have been a 3 wave inside a channel. So if I actually draw it like this, you see it more clearly that what we ended up with in this whole phase was A, B, and C. So some kind of a 3 wave move, okay, where which ends up being corrective. So you had a corrective structure down, you had a corrective structure up, and then you have what can be either another corrective or a 5 wave fall. Either way, it's some kind of a larger, the odds of it being a larger ABC just went up. Okay, and so after this most recent correction in banking, where there's been a lot of negative sentiment around banking, apart from this rally, which would have been a value buying rally, we actually at a point where I think I'm hearing people start considering the idea that some kind of a growth cycle comes back to banking. It may not be great, but it'll have to happen. Even if there's a capex cycle pickup in India, banking is the place that has to make those loans. Whether they show high rates of growth or not from a credit perspective, they are going to grow from here, or improve in terms of profitability. So there's actually a case that this ABC ended, and we actually in a more bullish phase for banking from here. So that's again something to consider, that we may have ended a lot of negativity towards the banking sector, and the only thing to watch out for in the short term then are things like, are we completing a small 1, 2, 3, 4, 5 move here? If we are, then can there be a correction in banking before it really goes up? I think that's the only risk I see. And that risk is essentially something we watch out for. And we are ahead of the budget, right? We are on 12th of January. And somewhere ahead of the budget, usually, if the markets rally too hard, they can pull back, just out of fear. We saw that last year. It was pretty interesting when it happened in the Nifty last year. So I'll actually go to the Nifty chart, if it gives us some perspective. Last year we actually had a sell-off ahead of the budget. Now, unlike the last 2 months where we had a correction in October and November, or rather November and December, we didn't have a correction because the market was going up through October, November, December here. So this was a rally that started, I think, from the low in at the end of September, or then there was a correction in October, and then again from the low in October, we actually went up all the way into December, and that continued to stretch into January, and we peaked here around the 21st of January. Even here around the 13th of January, there was a peak, sold off again, made a higher high, and then we got a deeper pullback into the end, just before the budget or into the budget time. And then the market rallied after the budget. Now, this is one way of things happening. Another way is that, markets rally ahead of the budget and then just consolidate, waiting for news. So I don't know if that will happen. We may or may not follow the same pattern. We could either consolidate ahead of budget announcements. The craziest scenario would be that we continue to rally all the way into the budget. I think that would be something. Yeah, have people been talking about the budget? Everybody's so focused on US equity that they're trying to relate what Indian markets will do with US equities on a day-to-day basis, when what they should really be looking at is, this is the budget month. We usually respond after a 2-month correction. This whole rally is about a budget, whether it'll be good, bad, and good simply meaning that they'll spend. Just like last year, they decided to spend more on the economy, sort of ensured that you get that 8-9% growth. And if they continue to maintain that, given their tax windfall, then you can actually end up with another year of 8-9% growth next year. It need not come down to 8 or 7.5 or something like that, which some people might predict. you can maintain the same rate of high growth. And if you can do that, then the earnings which we are seeing at growing at 30% plus this year can also continue to grow at the same pace next year, which can then actually remain a positive trigger for markets. I think that's what the market is trying to anticipate. And unless the budget disappoints, in fact, if you rally into the budget so hard, the budget may not disappoint, but the market will anyway sell off after the budget, because there's something known as buy in expectation and sell on news, right? So when the news is there, it's discounted, everybody knows also markets peak out. So that's what we'll watch out for. It's too early to say exact pattern that will happen. The only thing I could say looking at Bank Nifty is that if you complete 5 waves somewhere, then yeah, maybe you'll get a minor pullback. But when I look at the Nifty, I can't see the same thing, because this is 1, this is 2, this is 3. So we are not in 5 in the Nifty. So it'll take at least 1 4th wave pullback and another 5th to complete a 5 wave advance. And then we can say, okay, now it's time for some consolidation. And if we complete 5 waves ahead of the budget, then maybe we'll enter a consolidation into or after the budget. So that could be one more scenario to watch out for. But we haven't completed 5 waves, which is why I would continue to remain bullish. People who follow patterns would look at this pattern breakout, and usually pattern breakouts means you get an equally sized move after the pattern, and that sort of points towards 18,300 or so, which is what I've been writing about in my daily notes. And we are more than halfway there now. So as much as it was unbelievable to people at 17,400 that we could cross 18,000, well, we're already there now. We are closer to 18,200 now. So much for that. So I'll leave you with this. I've sort of built the picture that I'm watching for the next couple of weeks. And if you need a more deeper dive, broader view picture, read the long short report that is already published. And the part 2 will follow once we get a confirmation from the dollar index. That's broadly what I've been saying and will do once we get that additional information. Yeah, so before I leave, I would really want to leave you with this thought, which I started off right at the beginning, that what are you really listening to? So if you're listening to conspiracy theory, if you're listening to sites that are, permanently saying the same thing irrespective of the situation, what you really should do with those places is try to learn from the analytical aspect of it and understand what moves what aspects of, which, moving part in the whole macro space, whether it's the dollar, whether it's the bond market, affects what and why and how. So that learning definitely you can make from a lot of the analysis that they publish, when they're trying to get attention. But at the end, you should learn to see what the markets are actually doing, because if what they're saying is not happening, what are the markets doing? Why are they doing so? And once you've broadened your understanding of that, then you'll actually not miss out on the big trends that are going on. You'll be able to put reason to it that fine, all of these things which are possible are really not happening right now. They might not happen for the next 5 to 10 years. And this is not the right time to pay attention to a lot of those factors. And maybe those factors are moving in a completely opposite direction. Maybe there's a reverse bull market going on. For example, I believe that we've been in a dollar bear market since 2017, and if not since 2020. And that's a very important piece of information, because it determines how I am positioned. And so if you start believing, no, dollar will go up and, it's going to cross 100, do you have a good reason for that? And if that is what is happening right now, then why aren't all the asset markets that I've discussed today crashing all over the place? Why aren't emerging market currencies collapsing? Why isn't the rupee already at 80? And if that's not the case, if you cannot see impulsive moves to the upside on the USD INR, if you can't see that in, say, the Australian dollar, then something is not right in that analysis, right? So think about it and act accordingly. Commodity prices are not crashing if the dollar is rising. Only one of the two can be right. And so read conspiracy theory only to learn from it, not to get, engulfed by it, and then take your own view on what these various markets are doing, which is what I try to publish on an everyday basis, and get hold of the long short report and see the big picture view on all of those assets as well. So that's all from me for today. Thank you.